All right, so along those lines, another question here, and Jake, we'll let you lead off. Which Chicago neighborhood do you think has the best chance of having its housing price double from their current valuation? So I guess to rephrase another way, given where the prices are today, which neighborhood is going to be the first neighborhood to see that price double from where it is today? Who's going to have the next big pop?
Yeah, I mean, I'd say that there's a big difference, and it's a lot easier to go from $100,000 valuation to $200,000 valuation, right? So, if you're trying to go from 500 to a million, for example, or cut that in half and go from, maybe where the single families are worth 200 to maybe where they're going to be worth 400 in the next 5 years, I'm kind of on the Blake train here because I want to be as close to the loop as possible on the west side without getting, too hairy. So, for me, I'm a fan of these areas on the near west side that have proximity just simply because of the proximity to downtown, right? Like East Garfield Park, the east side of Douglas Park, if you can be east of the park, they still call that Douglas Park, but you're, right along Western there. West Humboldt, but not, too far west. And, really the west side Ukrainian Village, just because, again, you're just so close to downtown, and we've already kind of see it happen. So if you're looking at places where proof is in the pudding, like East Garfield Park, 5 years ago, semi-decent two flats that were 250 are now 500. Like it's already there, and there's still room to grow. So I don't even transact a lot in East Garfield Park, but I still like that area. I'll also kind of add on to that as well, but just kind of shift down to the southwest side. We've seen so much growth in Pilsen, and I'm always pushing heart of Chicago and like the west side of what used to be called like heart of Italy and Marshall Square. I think those areas, they're not the prettiest ever to drive through, but proximity to the Pink Line, you shift that southwest side up to what would be the equivalent of the northwest side, and you're at Wicker Park. Wicker Park and the Pink Line, the California Pink Line are only about 25-minute L ride to the loop, right? So these are just, some obvious things that I look at which give these places just so much potential to just go through the roof.
I like it. What is and then maybe you don't know the answer to this, is the city doing anything there? Like, is this part of some of those, Invest by Southwest, the TIF programs? Like, is any of that kind of subsidizing some of this growth here?
East Garfield Park getting a lot of attention, and it's not the South by Southwest initiative from what I know, but they've dumped a lot of money into Garfield Park, the conservatory, and like things over there. There's been some startups in some of these warehouse spaces that were like adaptive reuse buildings. I don't know the exact addresses, but there was a lot of tax incentives given for people and businesses to kind of grow in some of those areas on the near west side, which still I think have room to go. I don't think there's a lot of money being dumped into Marshall Square, for example. There is some rumor and some talk about approval for a trail that would potentially connect Pilsen to Little Village along the train lines there. And the name's escaping me at the moment, but that's something I'm always kind of looking into because we spend a lot of time with multifamily deals in that kind of region. And if that happens, similar to the 606 and the Bloomingdale Trail, I think that would be enormous for the area. I don't see it being a negative at all. Connecting Pilsen to Little Village would, create a lot of positive flow, in my opinion.
The El Paseo is the trail down there.
There it is. Thanks, Mark.
Look at you. Good job.
Still very initial, and I think they talked about it, but it's not happening yet.
Got it. All right, Matt, same question. Where do you feel the next big pop's going to be in Chicago?
Yeah, it's a good question. I mean, I think Jake hit on a lot of stuff as far as what we'll see in the shortest period of time. A high level of appreciation. In my world, dealing with larger multifamily, it's harder to say. We do a lot of north side business. I spend most of my time in some of the neighborhoods that I had mentioned earlier. And, saying what's going to double in, a short period of time it's a difficult question to ask. But as far as just consistent, progressive, property increases of value and appreciation, consistently year over year, The neighborhoods that I mentioned earlier, Uptown and Edgewater, for example, even like Rogers Park and parts of Albany Park, Ravenswood, I mean, they're trading at cap rates that Lincoln Park and Lake used to trade when the cap rates in these further north neighborhoods were double, 300 points higher. So I think now with the amount of prospect for rent growth in those neighborhoods, when you factor that they're trading at 5.5 caps now, just like Lakeview and Lincoln Park, and you're looking at rents that are currently 15-20% lower than those adjacent neighborhoods. It's hard to say what would happen in a year's time or so, but over a reasonable period of time in the near midterm, I think those neighborhoods are going to continue to appreciate a lot because, in our world, a lot of our valuations, as opposed to single families or condos or small multi-residential, these deals are largely valued at, income and cap rate in a lot of ways, multiples of income, cap rate. And the per door, and that per door keeps rising quite a bit. So I think you're going to see a lot of steady increase there. It's not a big pop. I think Jake's right. I think those other, secondary markets in the city are more ripe for bigger, quicker appreciation. It's just not the world that I spent a lot of my time in. So I don't know as well.
We're talking a very optimistic tone here. And one thing I want to point out is, not be a buzzkill, but East Garfield Park right now is almost exactly in the state Bronzeville was in 2007 before the market crash. Bronzeville didn't turn into what Bronzeville has in the last few years based on just the last few years. It was something that started in the back end of the last cycle. So anyone listening out there, Garfield, you don't know what's going to happen. And I don't think everything will ever drop like it did in 2008. But those type of edge areas are the first ones to slow down or even drop really quickly. Because all the speculation backs out. The people that probably maybe push the loans or got hard money loans are thrown in and stuff like that. If anything actually of serious consequence to the economy happens. So keep in mind, I agree with everything you guys are saying, but some of these edge neighborhoods, it truly turns into a long game. You want to make sure you're playing that long game.
Mark, if I can add to that, because it's a good point. In the last several years, because of how attractive Chicago's been to out-of-state investors, a lot of these buyers are raising money, they're syndicating deals, at least in the larger stuff that we typically sell. And they don't know the city as intimately as maybe, some of the people on this panel or some of the people listening to this podcast that are Chicagoans. And on paper, a lot of these secondary and tertiary markets and neighborhoods in the city, they look great compared to everything else that's trading at 5 and 6 caps. You get an 8, 9, 10 cap deal on paper, at least. It sounds great and you're in Chicago on a macro level, but you're right. When the market turns, those tend to be the markets that do get hit first. And we've seen those markets for that exact reason. New Yorkers or people from California coming in, raising money. They're placing it in the South Side or some of these, other markets where they're getting these big on paper returns. And then what happens is the property values shoot up. But then we've seen those same properties trading in much shorter periods of time because those operators don't know how to manage and maintain, that product, as well as, the north side that's longer term holders. So properties don't trade hands as frequently. So I do think that same driver that is shooting up those property values could be the same thing that is, potentially just a risk factor that you want to be aware of before you place a lot of money in those deals.
And I'll just, before we move on, one more thing. A well-capitalized property, meaning you're not 110% into the value like a lot of people were in 2008, and a well-run property with, smart management, or at least you're putting the right tenants in there, and you're doing that. If you can make it through a 3 or 4 year type low, and it still be a good investment, you come out the other side with these big gains. So I think it's just something to point on there. And a lot of these out-of-state people that don't understand like what you were saying are the ones that end up being victims, and you don't have to fall with them, is I guess the point I'm trying to make, if you run a good game.
Yeah, you nailed it, Mark. You guys nailed it dead on. You guys brought us on as experts, and then now when it crashes, we're going to be like the fools of the podcast when it depreciate, right?
But we can edit this thing up, don't worry.
Let's edit it. No, I'm kidding, but it is interesting. I think you nailed it with out-of-state investors. I mean, I think they have to be in it for the long term and have the right management in place in the right capital, because folks buying it 100% and no way, very small returns, it's a dicey game.
I just don't want us to sound like economists. No offense to economists, but I remember sitting and listening to the economist speeches in 2008, and then Lehman Brothers falls like 6 months later. But their forecast is like it's fine and everything's healthy. So I want to make sure that we keep it real for our listeners.